It seems like every time you turn around, there's a new way for your taxes to go up. About 3 or 4 years ago, there was a wholesale change to the tax code, and a lot of people thought this was going to be a big windfall. And for some, it was. That was unless, of course, you owned a home and you lived in a high tax area. Those that owned their home saw the deductibility of their real estate tax drop significantly, and hence their tax deduction on their home dropping significantly as well. The government is constantly thinking of new ways to balance taxes between what they need and what you have to give. Sometimes they give, a lot of times they take. And some of those tax surprises have been there all along, but you were just too young to really think about them. But now is the time to think about them. Now let's get into it. But before we do, if you haven't subscribed to the channel, please make sure that you click subscribe and turn on notifications so that you get alerted the next time I post a video. I post about twice a week. All right, let's go. Point number one, this is an obvious one if you're thinking about it. If you haven't thought about it, it will be a shocker. And that is when you withdraw funds from your 401k or your IRA, you have to pay taxes on them. Believe it or not, a lot of people miss this. If you're not one of them, stick around because I'm highly confident that one or more of these will be one that you've missed. But this one, the reason that people miss this is because it's all done in the background. You work your entire adult life, and as you work, your check comes net of taxes. In fact, not only does it come net of taxes, it comes net of your 401k payment in most cases. And assuming you used the 401k option or other deferred tax vehicles, you're now faced with the benefit of all of your life's work and all of the contributions you made to get to where you are now. But this is a really important point. Just because you're in retirement doesn't mean that you have special federal tax advantages that you didn't have before. There's no special retiree tax rate for your pension or your 401k. So when you take the funds out from your 401k or your IRA, assuming they're a traditional 401k or an IRA, remember that you need to hold a certain portion back for Uncle Sam. Point number two, most states do not tax Social Security. 37 states do not tax Social Security, basically 3 out of 4. And not to name shame, but the 13 states that do are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, and West Virginia. This basically means that if you live in one of those 13 states, assess whether your tax rate is high enough to not live in one of those 13 states. Point three, the tax on long-term capital gains isn't what it used to be. For most of you, the tax on long-term capital gains is either going to be 15% or 20%. If you're single and you earn over $40,401, you pay 15%. If you earn over $445,851, I know it's a lot of money, then you pay 20%. If you're married, those thresholds are $80,801 or $501,601. Now you're saying, Jeff, I hear you, but that's not me. I don't earn that much money. Now remember, this doesn't mean you have to earn those numbers every single year. If you have long-term capital gains, there's a reasonable chance that you have one or more assets that have been growing over time, and it doesn't mean that every year you're going to be selling assets. But what it does mean is that in any particular year, if you sell a big asset, you could get hit with big long-term capital gains tax. The next point is that while long-term capital gains aren't what they used to be, dividend income is definitely better than it used to be. Remember those thresholds I talked about? They apply for dividend income as well. So if you have dividend paying stock, as long as it's what's called qualified dividends, you'll be paying 15 or 20% depending on your total income. The final point is that Social Security benefits are often taxed. At one point, Social Security benefits weren't taxed, but then in 1984, the government put a tax on Social Security depending on the amount of earned income that you had. This created some confusion because people remember hearing somewhere that Social Security wasn't taxed, because they don't meet with a financial planner. It's stuck in the back of their head and percolated for about 20 or 30 or 40 years in some cases. Now is the time to dust it off and talk about it, because it probably hasn't been talked about enough, at least with some of you, until this very moment. The government uses a term called combined income. This is income from taxable sources like your 401k or your pension. It also uses 50% of your Social Security benefit. They combine your taxable income from 401k, wages, and other sources, AGI, plus your Social Security, 50% of your Social Security, and municipal bond income. The three of those together are what are collectively called combined income. If you're single and the total of those three is $25,000 or more, then you'll probably owe some tax on Social Security. If you're married and the combination of those three is $32,000 or more, then you'll probably owe some tax on Social Security. I have a video, I'll put the link in the description box below so that you have it, and it discusses how the tax on Social Security works in more detail. If you like this video and you'd like to see more of me, please make sure you click subscribe and turn on notifications. Social Security and retirement income is changing fast. Particularly now, I'm working very hard to get what's out there in here for you, because there's a lot that's going on. Also, check out this video on what to do if you're 60 years old and you have absolutely no retirement savings. This is Jeff Schmidt. Thanks for watching.